You bought a house. Your friend bought stocks. 10 years later, one of you is rich. One of you is quietly devastated. And the worst part? The one who lost made the decision that everyone told them was smart. Stay with me, because in the next few minutes, I'm going to show you the actual math. No opinions, no bias, just cold, hard numbers that will completely change how you think about building wealth. And I promise you, by the end of this video, you will never look at a property listing or a stock chart the same way again. Let's start with a story. Two cousins, same age, same city, same starting capital, 20 lakh rupees each. Cousin A buys a flat, cousin B opens a brokerage account. Fast forward 15 years. One of them retired early. One of them is still waiting. Which one won? I'll tell you, but not yet. Because if I tell you now, you'll skip the math, and the math is where everything changes. First, let's talk about property. Because for most of us, property feels safe. It feels real. You can touch it, you can live in it, your parents approve of it. Your relatives brag about it at weddings. And look, property has genuinely made a lot of people wealthy. That's not a lie. But here's what nobody tells you about the property calculation. When people say, I bought this house for 40 lakh and now it's worth 1-2 crore, they are only telling you half the story. And the half they're leaving out is the half that actually matters. Let's do the real math. You buy a property for 40 lakhs. You take a home loan because almost nobody pays cash. Your EMI over 20 years, let's say around 35,000 rupees per month at a standard interest rate, over 20 years. You've paid roughly 84 lakh rupees in EMIs alone. Then add maintenance, society charges, repairs, painting, plumbing, conservatively 2 to 3 lakh over the years. Add property tax, add registration and stamp duty from the purchase. Add brokerage when you eventually sell. Your real cost? Easily 95 to 100 lakh rupees. And your property is now worth 1.2 crore. So your actual profit is around 20 to 25 lakh rupees over 20 years. That is not a bad return. But it is also not the fortune people think it is. And here's the number that will stop you cold. The annualized return on that investment, when you factor in total outflow, works out to somewhere between 5 and 7% per year, sometimes less. Remember that number, 5 to 7%. Now let's talk about the stock market. And before you switch off, I know what you're thinking. It's risky, my. It crashed in 2008. For my uncle lost everything. We'll talk about risk, I promise. But first, let's just look at the numbers honestly. The Indian stock market, specifically the Nifty 50 index, has delivered an average annualized return of approximately 12 to 14% over the last 20 years. Not every year. Some years it fell 40%. Some years it rose 80%. But on average, across 2 decades, 12 to 14% per year. Now let's run the same 20 lakh rupees through both scenarios. Scenario 1, property. You invest 20 lakhs as a down payment. You pay EMIs for 20 years. Final value, let's be generous, 1.2 crore. Total outflow, including all costs, approximately 1 crore. Net gain, around 20 lakh. Scenario 2, stocks. You invest 20 lakhs as a lump sum into a simple index fund at the start. No EMIs, no maintenance, no phone calls from tenants, no paint jobs. At 12% per year over 20 years, that 20 lakh becomes why, and I want you to actually sit with this number, 1 crore 93 lakh rupees, almost 2 crore, from the same starting amount, with zero ongoing cost. And if instead of a lump sum, you had taken that EMI money, that 35,000 per month, and invested it into an index fund instead of paying a home loan, run the CP calculator. At 12% over 20 years, you'd be looking at somewhere north of 3.2 crore rupees. That's not speculation. That's compounding. That's just mathematics doing what mathematics does when you give it time. Now, I promised you we'd talk about risk, and this is where it gets real. Property feels safe because the price doesn't flash on your phone every morning. You don't open an app and see your flat is down 18% today. That psychological comfort is real, and it has genuine value. For many people, that stability is what keeps them invested long enough for returns to actually compound. Stocks, they will test you. There will be a year, maybe 2, where your portfolio looks like a disaster, where you question everything, where every news channel is telling you the market is collapsing, and you should sell immediately. And most people do sell, which is exactly why most people don't get the 12 to 14% average. The average investor in the stock market earns far less than the market return because they buy high when they're excited and sell low when they're afraid. So here's the brutal truth. The stock market doesn't reward intelligence. It rewards patience. And patience is a far rarer skill than most people realize. But here's something the property crowd never wants to admit. Property is not actually low risk. Real estate markets crash too. They just crash slowly, quietly, and in ways that don't make headlines the same way. Ask anyone who bought property in certain cities in 2012 and 2013 at peak prices, like some of those properties, are still not back to their purchase price. A decade of your money locked up, earning nothing. Worse than nothing when you account for inflation. And unlike stocks, you cannot sell 10% of your flat when you need cash. You cannot rebalance. You cannot exit in 10 seconds if the fundamentals change. Liquidity is a form of risk that nobody talks about. And property carries enormous liquidity risk. So where does this leave us? Let me give you the framework that actually matters. Because this is not a shares versus property debate. That's the wrong question. The right question is this. What combination of these assets, in what proportions, for what purpose, actually builds the most wealth for your specific life? Property makes tremendous sense when you need a place to live and your rent cost would exceed your EMI cost. When you have the financial stability to absorb EMIs even through tough periods. When the city and location have strong long-term fundamentals. When you are buying for 15 to 20 plus years and not looking to flip. Stocks make tremendous sense when you want maximum long-term wealth generation. When you can stay invested through volatility without panic. When you want flexibility and liquidity. When you're in the early stages of building, wealth and compounding has the most time to work. And here's what the wealthy actually do. They don't pick one. They use property as a stability anchor and equities as their wealth engine. One gives them peace of mind. The other gives them exponential growth. Now let me come back to those two cousins. Cousin A bought the flat. 15 years later, it's worth good money. He has an asset. He has equity. He feels secure. Cousin B invested in index funds consistently for 15 years, through crashes, through COVID, through every moment of doubt, 15 years at 12% on 20 lakhs, with monthly SIPs of the money he saved by not paying EMIs. Cousin B has more, significantly more, and his money is completely liquid. But here's the twist. Cousin B also has anxiety, because every few years markets crash and his portfolio bleeds. He needed discipline that most people simply don't have. Cousin A sleeps better on most nights. And that peace of mind has a value that doesn't show up in any spreadsheet. So what's the answer? The real math says equities win on pure returns, almost every time over long periods. But the real world says the best investment is the one you'll actually stick with. Run your numbers, not the headline numbers, the real ones. Total outflow, total return, annualized percentage, opportunity cost, and then build a portfolio that lets you sleep at night while still giving your money the conditions it needs to grow. Because here's the final truth that nobody wants to say out loud. It's not shares versus property. It's financial discipline versus financial avoidance. And the people who win, they chose discipline, in whatever form that took. If this video changed how you think about your money, even slightly, then share it with someone who needs to hear it. Because math doesn't care about feelings. But you showing someone this video just might change their financial future. See you in the next one.